Hi, Steve London. I wasn't going to do a video today, but this is, towards a market close. It's January 27th, 2020. I thought it would be a good day to show you how you can build a dividend portfolio yielding 10% that doubles every 7 years, and you can make crazy proof, market crazy proof. So it can be done. I will show you how. And this portfolio works in just about all conditions. It works when it's going up, it works when the market's going down, and it makes you look smart no matter which way it's going. So I will show you how to do it, and I will show you it's up today, and we'll show you how you can make money when the market's not behaving. Client portfolios or ex-client portfolios. I started it at 6.1. Today it was down 0.61% as opposed to 1.57. It throws off a dividend yield of 12%. It was up 19.6% last year. It's up 3.1% to date. That means it's outperforming the S&P pretty much. And its 10-year return is 372%. Now this is more indicative of, double every 7. This is 10 years, we got considerably more than a double. But in 5 years, we were at 78, which is pretty close to a double. So we are looking at a better return. It's got a 12.1% yield, and it's at 3.1% this year. So this is more in line of what we're looking at. So let's compare this to 60% bonds. How did those do today? This is an extremely conservative portfolio. It's got 60% bonds and 40% stocks. And it was down today because, this was a pretty big move. So let's get down to what we're really looking for. So this is a portfolio that I made. It was new money. This is called the Monitor. I don't know why I just name them. I created this on 9/13. It was down 69.69%. It was basically 0.7. It's got a beta. It's a low beta. It's up 1%. The yield is 8%. The historical returns is 2 years. On 10 year, this is up 576%, which is nice. 5 year return is 111%. So that means this one got a double in 5 years. So what we do, and remember when I showed you that little graph of arithmetic of losses, what you do is you put a hedge in, and this is the same portfolio hedged, and the hedge is the VXX. So all you do is when the market starts getting crazy, you put the VIX hedge in, and so all of these positions, and there's 8 of them, there are actually 7 of them, it's equal weight. So if you have $10,000, you divide by 7, and that's your positions. And then if the market starts getting crazy and you don't have the excess money, what you do is you take the one with the highest beta and the lowest return, which would be maybe, oh gosh, let's see, this is Monitor. Let's just for drill, okay, we're going to lose SLRC, and we're going to remove, okay, we have the same amount of money then, and then today this portfolio was up almost 1%. So it's significantly outperforming the market, and it actually does better when the market's going down. And the VIX, it's kind of like a parachute. So when the market gets really crazy, it kind of explodes, because this was up 10% today. And when the market, the fear gauge and the crazy, I call it crazy gauge, gets really, really going, this really helps out a portfolio. It adds a lot of flotation and helps you from losing money. So the other portfolio I do is, this is actually my own. I had some money. As usual, this is the beginning of the year, like January 3rd. I really wasn't crazy about putting money in this market because I really don't trust it. But the only way I would do it is in this condition, in this portfolio, where I knew I could step in and do something. So this has done well. It's up 5.3%, which is really outperforming the S&P. So this one I looked at where I wanted where the puck was going to be, and that's the way I set this up. Historical returns are not great, but the short term, 6 months, 3 months, it's up 4.5%. So that's good. You go out to 10-year and it's okay. But today, or actually Friday, I put a hedge in, and this is what it looks like now. So I put a hedge in, it was up 1.28% today. So when you think about it, the market is going down. It was down, fairly. This is the second day in a row. This portfolio throws out 12.7% hedged. It's a 0.49 beta, but this is what happens when the market goes down. You've got a portfolio like this, and it actually goes up. So this is what I'm talking about, is you can draw your line in the sand with this type of investing. Now, what I've already done is, I don't know when the market's going to turn. It could turn tomorrow. This could be the big one. It could go down another 40%. I don't know. I don't really care. But if it goes up, I've already put a sale in on the VXX position. So what I did is I put in a trailing stop. So I did about an 8% trailing stop. So what that is it can go up all you want, but when it starts coming down, and this is just as volatile coming down, when it comes down, it's 8%, I'm gone. So that's how you can't really time the market, but you can have the market kind of tell you when to get out. So that's what I've done here. So this basically is a demonstration on how you can make money and not lose money, and when you have big fluctuations in the market, and the bigger this really is, does well. And at the tail end, you've got your hedged position. It's going to grow, and when the market finally does turn, if it's a long downturn like in 2009, you can really make some pretty decent money. Last year we did the same thing. At the end of 2008, it was down 20%. We did this, had a pretty good cash position, and we bought some stuff really dirt cheap, and that was some of the best trades we had all year. So this is how you do it. It works, and I hope you enjoy it, and I hope you learn something. That's it. So you have a good day. Thank you.